Hello everyone. My project is on how different stock indexes in the S&P 500 perform under different economic conditions. So things like inflation, recession, recovery periods, and world events. The goal here was to see which indexes perform best on what's happening in the economy. For the indexes chosen, I'm focusing on technology, healthcare, real estate, energy, and industrial. There are 11 total indexes, but these 5 are widely recognized and show very clearly the differences of performance. The timeline I chose starts in 2020. The reason why I chose this is because it's when the market hit the most dramatic periods of recent history, which was the pandemic. Before looking at the data, it helps clarify the difference between sectors and indexes. An index is a collection of investments that represents a segment of the stock market itself. In this case, it's the S&P 500, which includes 500 of the largest U.S. companies, such as Microsoft, Apple, Nvidia, Pfizer, and Cigna. Other examples include like the NASDAQ 100, which tracks 100 major tech companies. You can think of an index as a snapshot of the market's overall health. So it's like checking the temperature to see if it's hot or cold. And sectors, which are a group of companies by what they do in their industry. So for example, technology, so there's Apple and Microsoft. Healthcare, there's Pfizer and Cigna. And energy, there's Exxon and Chevron. The key difference is an index can contain companies from multiple sectors, while a sector contains companies just from one industry. So think of it like this. Sectors are neighborhoods in a city. Indexes are thermometers that tell you how hot or cold the neighborhood is. With that in mind, we can now look on how these indexes reacted to major events. So starting off here, we have the COVID crash of 2020. COVID emerged in early 2020, and by March, nationwide shutdowns began. In this graph, you can clearly see that each index drops at almost the exact same time. When the pandemic hit, investors panicked and pulled out nearly all assets because of uncertainty and halted production worldwide. Even though tech companies could operate remotely, the market sold off everything in fear of a full collapse. So once people realized digital tools like Zoom, Amazon, and Microsoft were essential for lockdown life, tech began to rebound first, leading the recovery. But keep a close eye on the green index here, which is real estate here. So when we zoom in here on real estate, it tells a different story. Real estate dropped nearly 40% in just a few weeks, which is unusual because of housing is normally stable. This ended up being one of the best buying opportunities in years, but most people could not act on it here. The market froze listings, stopped showings, and finances slowed. Because the window only lasted about 6 to 8 weeks, prices rebounded quickly, and once the market adapted there. With that said, let's go on to 2021, which I like to call the American Rescue Plan. After the initial pandemic crash, the market entered a recovery phase. So we received like stimulus checks, business reports, and vaccine rollout, which helped stabilize the economy. The American Rescue Plan was nearly $1.9 trillion, which boosted confidence and markets upwards. As you can see here, these are most indexes moved steadily throughout 2021 without major volatility. Then on the right, it shows the stimulus packet that was distributed. So there's like, we got government money, we got agriculture, other education, you name it. So here's some observations I found in 2021. Tech continued to rise here because of remote work, and e-commerce became long-term habits, not just short-term solutions. Meanwhile, healthcare stayed strong due to ongoing vaccine production and medical demand, while energy and industrial indexes recovered more slowly because of travel, manufacturing, and in-person work. They were still limited in early 2021 here. So there's another pattern I do want to point out here, and there's some cool history behind it. So October features a market dip here. While that might seem like a normal cycle, it's rooted into something specific. The 1929 crash that started the Great Depression happened in October, which that date still spooks investors to this day. So some fear history might repeat itself. They call this phenomenon the October effect. So what happens is investors anticipate volatility in October, leading investors to sell off stocks and create short-term market pressure, especially if markets were strong earlier in the year. Another related factor is that by the end of the year, investors often sell off assets to realize losses for tax purposes, which can contribute to market dips as well. So with that said, let's go on to 2022. So to start off 2022, we had, it was the Russian invasion on Ukraine, which started around January. Which dove the market here because of the surprise and the support from the U.S. to help Ukraine by sending weapons and money over to aid them, which made the market dive here. An important factor is inflation in this year, which was really insane at this time, but you can see inflation drastically rises throughout 2022, which is the blue line, which rose gas prices, store prices, car prices, you name it. From the looks of the graph, it looks like inflation just keeps on going up, but the little bumps, short dives, and short jumps affect the market here like crazy. With that said, high inflation hits tech harder at first because investors move away from high growth companies when interest rates rise. Future profits seems less valuable. However, once the Federal Reserve showed it was serious about fighting inflation, confidence returned and tech stabilized. And we go on to 2023, which I like to call AI boom. So the year 2023 began with a jolt, the high-profile failure of Silicon Valley Bank on March 10th. This event sent shockwaves through the tech and finance worlds, causing an initial market plunge that quickly rebounded. The graph from the period shows a small dip, then a quick recovery. The narrative then shifts dramatically in the spring and summer, so April and July, with the onset of the quote-unquote AI boom. The AI boom created a wave of optimism. Investors saw it as the next big thing after the internet and smartphones. Whole bunch of capital poured into these companies developing or integrating AI, especially in semiconductors and cloud computing, which pushed the entire technology index upward, even while other indexes remained steady. So here's the difference between the graph of 2023 compared to 2022. In 2022, tech moved cautiously because of inflation and rising interest rates, but in 2023, once the AI boom began, tech broke away from the other indexes and rose sharply. This is one of the clearest examples on how innovation can overpower economic uncertainty. And then to end the year in late 2020, there was a conflict in Israel that pushed oil prices up, which affected energy and the market overall. And like how we talked about earlier, the October effect also appeared again here, a short dip driven by investor caution, but the market recovery by the end of December here. With that, let's move on to 2024. So start off 2024, it was first off, it was presidential election year, so the market was already uncertain. On top of that, Japan ended its negative interest rate policy, the first major rate hike in over 17 years. In this graph, you can see the effect it had in March in tech, but it's very minor. And let's take a closer look on how it affected interest rates here. So shown in red on the left is health, and on the right is energy. You can see the impact it had on the market here. Japan's negative interest policy suddenly strengthened the yen and pulled investment money out of the U.S. markets, which triggered the Wall Street downturn in early 2024. The Japanese policy shift showed how interconnected global markets are. When Japan's rates rose, investors moved money from U.S. stocks to Japan for higher returns, briefly draining U.S. liquidity. Tech, which depends heavily on investor sentiment and capital flow, dipped slightly but stayed resilient compared to most traditional indexes here. The Federal Reserve responded by cutting U.S. rates later in the year to stabilize the market, which caused a short recovery. But the rebound didn't last, showing how sensitive the market still was to global interest rate shifts. All in all, 2024 shows that global interest rates can move U.S. markets just as much as domestic policy. And finally, we have 2025, the year of tariffs. In early 2025, the U.S. government imposed significant tariffs on a variety of foreign imports, which quickly impacted markets by increasing costs for businesses and dampening international trade. The economic volatility was compounded by geopolitical events. The Gaza war ceasefire, which was January 2025, was substantially broken in March of 2025. A slight market downturn was observed during this period of combined economic and political uncertainty. Tariffs raised production costs for tech hardware, especially semiconductors and electronics, which is all imported from Asia. That pressure, combined with delayed rate cuts, temporarily cooled the index's momentum. Still, once markets adjusted to the new trade environment, tech rebounded faster than energy or industrial indexes. Then mid-year in March, inflation pressures were not cooling fast enough because of the Federal Reserve signaling delays in interest rate cuts. When the expectations were pushed back, stocks dropped sharply. Something else I wanted to mention is if you compare 2025's dip to the COVID crash of 2020, the pattern here is very similar, which is a sharp fall followed by a recovery once investors adjusted to the new conditions. So to answer my question here, across all years, technology consistently showed resilience because it adapts faster than other indexes. Its products and services are global, not local, and it thrives on innovation cycles, not physical supply chains. That adaptability is why tech often leads recoveries after crises and why investors include it to favor it in the long term. So overall, what I found across all these events, from recession, inflation spikes, interest rate policy changes, unexpected crises, and even the AI boom, which is each major shock hits the market differently. Some indexes collapse fast and recover slowly, others barely move at all. But the key pattern I kept on seeing is that technology consistently bounces back the strongest. Even when the tech index took a hit from COVID, inflation, rate hikes, the Silicon Valley Bank collapse, it still recovered faster and rose higher than the others. And during periods of innovation like the AI boom, tech didn't just recover, it outperformed everything else. So the main answer to my question here, which index performs best under economic conditions, The data shows that technology outperformed it in every scenario. It is the most resilient, the most responsive to economic change, and the most driven by innovation rather than just market conditions. So at the end here, why should we invest in technology? Technology has proven it has been the most adaptable and resilient index throughout every major economic shift during crises like COVID. Innovation allowed tech companies to pivot faster than other indexes, even when it was faced with inflation, rate hikes, or global trade tensions. The demand for digital infrastructure, AI, and automation continue to grow. Tech thrives on long-term innovation cycles rather than short-term market trends, which makes it one of the few indexes that not only recovers quickly, but also drives future economic growth. Investing in technology means investing in the tools that shape every other industry's progress. And with that said, does anybody have any questions? And thank you all so much for watching.